Hi everyone. Now let us explore a financial modeling project related to cafe, whether it is feasible to expand or not. So these are the information given. There are some assumptions. So the total project cost is 1.3 crores and the project life is approximately 6 years and 70% equity and 30% loan it is funded for 94 lakhs and 36 lakhs. And this 36 lakhs loan tenure is 6 years. Loan interest rate is given as 10% and KA is given directly 12%. Corporate tax rate is 30%. And some assumptions like first year annual sales value will be 50% of total investment. Operating cost is given as 50% of sales. And depreciation it is given as straight line method 20 lakhs. So it will be 1 lakh, 1 crore 30 lakhs minus 10 lakhs divided by 6 years. It comes to 20 lakhs. Now, talking about sales revenue and growth, first from 1 year to 3 years, the revenue growth will be 20%, and from fourth year to sixth year, the growth will be 25%. And now, let us go to WACC calculation first. So, here now the KE is given in base data and assumptions as 12%. And cost of debt, the formula will be interest rate into 1 minus tax rate. The interest rate is given as 10% into bracket 1 minus, and the tax rate is given as 1 minus tax rate is given as 30%. Now I'm getting cost of debt as 7%. The equity amount will be 94 lakhs and that amount will be 36 lakhs. The total comes to 94 lakh plus 36 lakh, 1 crore 30 lakhs, and the tax rate is given 30% corporate tax rate. And WACC formula will be equity amount divided by total capital amount into cost of equity plus cost debt amount divided by the total capital into KD. Now we are getting WACC value as 10.62. Now let me mark it, and this 10.62 we will use for discounting. Now let us proceed to revenue forecast. So revenue forecast, as mentioned in assumptions, in year one there will be no growth, and in year two it is mentioned 20%, and year three will be same 20%, and for year four to year six it is given as 25%. So year five 25% and year six 25%. Sales value first year it is given as 50% of total investment. Total investment is 1 crore 30 lakhs into 50%, 65 lakhs. Now we will apply growth rate from second year. That will be 65 lakhs into 1 plus growth rate is 20%, 78 lakh. Now I'm drawing the same for the rest of the years. And the operating cost percentage is given as 50% of sales. It will be same for every year. Let me fix this cell value. It will not change. Okay, 50%. And operating cost will be sales into operating cost percentage. So it comes to 32 lakh 50,000 and dragging for the rest of the years. Depreciation is directly given as straight line method 20 lakhs for every year. So let me fix this cell as well. So 20 lakhs and same for the rest of the years. Then EBIT formula will be sales sales minus operating cost minus depreciation. I'm getting EBIT of 12 lakh 50,000 and dragging Then ROI, return on investment, will be EBIT divided by our total investment of 1.3 crores. I'm getting 9.62%. Let me fix this cell. 9.62. Now we got ROI also. This is the ROI values. Now let us proceed to loan amortization to calculate the principal amount and interest amount, which will be used in calculation of PAT. So the loan amount values are given here in base assumptions 36 lakh. Now let me drag the same values here. Interest rate and the not getting low interest rate will be 10%. So calculation of EMI formula will be PMT and the rate is 10%. NPR is number of years, loan tenure 6 years, and the value I'm giving it as negative because it is a payment. So I'm getting an EMI value of 8 lakh 26,586. So the total payment value will be equal to this EMI value. The EMI value will not change for every year, same. And the opening balance will be the loan amount, starting amount 36 lakh. Interest will be 36 lakhs into this 10%. And I'm fixing this value as well. So I'm getting 3 lakh 60,000 interest. And the principal amount will be total payment minus interest amount. It comes to 4 lakh 66,586. And the closing balance will be opening balance minus principal repayment. It comes to 31 lakh 33,413. And the opening balance of year 2 will be equal to closing balance of year 1. Let me apply the same here. So interest will be, I'm dragging here, 3 lakh 13, and principal repayment will be total payment minus interest, and the closing balance will be, okay. Now I'm dragging same for every year. If we are doing this, at last the closing balance should be 0. Let us check whether it is 0 or not. See, we are getting 0 here. So, and these interest and principal payment values we will use further in calculation of PAT. Now let us go to PAT and free cash flow calculations. So EBIT we already calculated in revenue forecast. I'm taking the same values here, 12 lakh 50,000, and we will drag the same for 6 years. So EBIT we got, and interest expense just now we calculated. I'm using a function called transpose here because the values are vertical and horizontal, so it will be easier to copy now. Interest amount, now we got interest amount, and EBT will be EBIT minus interest value 8 lakh 90,000. I'm dragging, so I got the EBT amount, and the tax rate is given 30%. That will be EBT into 30%. So the tax value will be 2,67,000. I'm dragging the same for 6 years, and the profit after tax PAT comes to earnings before tax minus tax amount 6 lakh 23,000. Dragging the same amount here for rest of the years. Now depreciation, it is given 20 lakhs. We have to add back this value to get the free cash flow. Depreciation is 20 lakhs. Let me fix this cell because it is same for every year. 20 lakhs. Now I will drag it further. So 20 lakhs. And loan repayment already we calculated in loan amortization sheet. So let me take these values. Even same here, these values are horizontal and so I'm using a function called transpose. Now we got the loan repayment also, and salvage value it will be at the end of the year, and it is mentioned in base data and assumptions as 10 lakhs. I'm taking the value 10 lakhs. Now free cash flows will be profit after tax, add depreciation, minus loan amortization plus salvage value. So it comes to 21 lakh 56,413, and I'm dragging the same values here. So now we got the free cash flow values. Using this, we will calculate NPV, IRR, and payback period. So let us proceed to NPV calculation. So initial investment at year zero is given in assumptions that 1.3 crores, and the discounting rate is given. We have calculated using WACC 10.62. As I mentioned before, we lose this WACC value, and free cash flow values we already calculated in this calculation. So let us take transpose here. No need of transpose, I think. Okay. Here it will take. Now I will drag the values. Here. No, sorry. From year one, FCF values. So we will drag for the rest of the years. And the free cash flow for the year one will be negative value of initial investment value. Okay. Now we will calculate NPV. The formula for NPV is it is called as NPV, and we have to mention the rate, WCC rate 10.62%, and the values will be from first year to sixth year. We should not include the initial investment here, closing it and add initial investment to this now. Now I am getting an NPV of 29 lakh 15,895, and let us calculate the IRR also. IRR is IRR, and we have to use this, give this sales values. So IRR I'm getting 16.6%. Okay. Now let us calculate the payback period. Now there will be two payback periods, normal payback period and discounted payback period. We'll calculate the both. So the free cash flow values I'm using transpose here because it is there it like this, and we have to paste here. So these are the free cash flow values, and we all know how to do the cumulative cash flows. This value plus this. So we are getting values here like this, and present value factor will be formula 1 by 1 plus R. R is 10.62. Let me fix this value because it will not change for every year. Whole power n. N means year. So 1 we are getting, and I will dragging the same. So these are the present value factors. Now discounted cash flow will be free cash flow into present value factor. We're getting like this, and I'm dragging it for the rest of the years. And cumulative cash flow, discounted cumulative cash flow will be like this. Here it will be this value plus previous value. Now, uh, now we got the cumulative discounted cash flow value, discounted cash flow values. Using this, we can calculate the payback period. Now let us see what is payback period. So the period where we get the break even, where free cash flows were getting zero are converted into profits now. See here we are getting, here we are convert the, so we can see this here the positive value comes in fifth year. So the payback period will be between 4 and 5. Now let us mark this 4 and 5. Okay. And here it will be in between 5 and 6. So it will be 4 and 5 means, so 4 plus, without sign we have to take this value, I'm putting negative here, and divided by this value, we'll get the payback period. So I'm getting payback period as 4.24 years. Now similarly we can calculate discounted payback period. It will be, it lies between 5 and 6 no. So 5 plus, without sign no, so I am adding negative here, and this value divided by DCF value of 6th year. Now I'm getting 5.26 as a discounted payback period and 4.24 as payback period. Now let us calculate return on equity. See, these are the values which were already filled because the formula is filled before. So these are the values which were already calculated here. These are the PAT values which we are taking now. So this PAT values we are taking here, and the equity investment, it is mentioned in base data and assumptions as equity investment is 94 lakhs. Now the average of these cash flows, uh, this profit after tax will gives you average PAT. Now return on equity formula will be average profit after tax divided by equity investment. We are getting 25.78% as return on equity. Okay. Now we will decide whether to accept this project or not, whether it is feasible or not. So for the decision, we have made some benchmark values and compare with our present values. WACC we already calculated here. We are getting 10.62%. So it is benchmark is if it is good if it is less than 12%. Is it is less than 12% or yes or no means, so it is less than 12%. So we can say yes. And net present value we already calculated. At present value will be 29 lakhs. It is positive. So it can be accepted, yes. And internal rate of return, it is good if it is greater than WACC. We got internal rate of return IRR will be 16.66% and the WACC will 10.5%. So it is greater than WACC. It is good, yes. So payback period, payback period, discounted payback period, which is generally good if it is within the life of the project. Our life of project is 6 years. Now payback period we are getting is 4.24, and discounted payback period we got 5.26. Both are within the project life, so these two can be accepted. Yes, and DCF value will be sum of discounted cash flow values. See, these are the discounted cash flow values from year 1 to year 6. Now making it a sum. So the sum of this discounted cash flow values should be greater than your, I think it is around 1.3 here. So it should be greater than our initial investment. Yes, it is greater than our initial investment. It is good. So accepted. And operating cost, it is given in base data and assumptions as 50%. We have used it in revenue forecast calculation. Industry average 60%, our it is 50%, so it is good. And return on equity were calculated 25.78%, and it is good generally when compared with KE. KE is the minimum rate of return they are expecting. They are expecting minimum rate of return 12%. We are giving double to it. It is absolutely good. Yes, accept it. So overall feasibility, we can say that overall feasibility we can accept this project. So we can say finally that this cafe expansion project is good and we can accept it. Now let us proceed. They have given some additional questions. So the first question is about determine the free cash flow required in addition for the project to achieve a payback period of 4 years. As of now, let me take these values first. Free cash flows values we got already, and let me take these values. Paste special with values. Okay. Now we have free cash flow values and cumulative cash flow values. We already calculated. Now again I'm doing 4 plus this value should not be negative side. So fourth year value divided by this value. Now, generally, we are getting 4.24 as our payback period. Now, they are asking how much should be the free cash flows in addition required to get the payback period exactly 4 years. So, now using a function called goal seek, we will try to calculate this. Now, let me go to goal seek data in this what if analysis goal seek, and the cell value we want to change is this one, and that value must be 0 by changing the cell value this one. So now let us see. The cell must contain formula. Oh, sorry. Let me erase these values as well. And here the cumulative cash flow will be this one. This one plus this. Now we are perfect. Now we will apply the goal seek formula here. Goal seek. We want to change this value. It should be 0 by changing this value. Now it is showing that payback period is 4, and for that our cash flow should be increased to 51,18,152. So 51,18,152 minus the present value is this value. This value. So in addition, we require this much amount to get payback period to 4 years. Now let us proceed to second question. Calculate the annual loan repayment EMI value if the tenure is reduced to 3 years. Initially, if you remember, the loan tenure is here is 6 years. Now they are asking if the tenure is 3 years, what will be the EMI value? Now let us calculate this. The formula for calculating is this PMT, and the rate is given as 10%, comma, N per value 3 years. So 3 instead of 6, now we are calculating for 3 years. And the EMI amount is 36 lakhs. 36. So the EMI amount comes to 14 lakh 47 613 if it is 3 years. If it is 6 years, we are getting 8 lakh 26,000. Okay. Now let us proceed to the last question. So they are asking us to calculate the MIRR of the project using finance rate of 10.5% reinvestment rate. So the formula for MIRR is MIRR. So the values we have to take values, comma, finance rate is 10.5%, comma, and reinvestment rate is given as 12%. So MIRR we're getting as 15%. Still, it is good as we when we compare IRR or MIRR, it is still greater than WACC. Now, even after calculating these values, we can finally say that this expansion project can be taken because everything is in good sign as we assessed everything here. So thank you.